You have been sold a comfortable lie. It goes like this. Just buy index funds, close your eyes, wait 30 years, and you will wake up rich. That advice worked perfectly for a specific generation, in a specific economic cycle that no longer exists. But for an adult starting from zero in 2026, blindly following the set it and forget it strategy isn't a wealth plan. It is a mathematical trap. Today, I'm going to show you why the safe route of passive investing is mathematically impossible for anyone starting with small capital, and exactly what the capital accumulation strategy looks like instead. If you are tired of feeling behind, this is the reset you need. So, watch the video until the end, and if you're new here, subscribe to the channel so you don't miss any future videos we upload. Let's start with one of the most misleading ideas in personal finance. The idea of average market returns. You often hear that the stock market returns 7 to 10% per year on average, and that if you just buy index funds and wait, you'll be fine. The problem is that your life is not lived in averages. Markets don't give you a smooth 8% every year. They deliver a mix of flat periods, big drops, and occasional strong years. When people show you a neat upward sloping line, they are compressing decades of volatility into a comforting story. If you're starting from a low net worth, this matters. Suppose you invest $500 per month into an index fund, and the market spends the next 8-10 years mostly moving sideways with a few drops and recoveries. On paper, the average over 30-40 years may still be 8%. But during your first critical decade, you've just been parking money into a volatile savings vehicle without meaningful growth. Time is your scarcest asset, not money. Average statistics hide the time risk you are carrying. Wealthy investors can wait through a flat decade because they already have capital working. If you are trying to build your first meaningful 50K, 100K, losing a decade to flat or mediocre returns is not just inconvenient. It can push major life goals permanently out of reach. The takeaway is simple. Relying on long-term averages is dangerous when your time horizon, age, and starting capital don't match the assumptions behind those averages. Another core promise of index funds is diversification. You're told that by buying a low-cost index fund, you're instantly spreading your risk across hundreds of companies and the entire economy. In theory, that sounds like a responsible wealth-building strategy. In practice, the structure of many major indices has changed. A relatively small group of very large companies now makes up a disproportionate share of the index. That means when you think you're buying the market, you're largely buying those dominant names and their specific risks. This concentration exposes you to sector-specific downturns more than you might realize. If those leading companies hit a period of stagnation, regulatory pressure, or valuation compression, your portfolio takes a direct hit, even though you believed you were safely diversified. For someone with a large existing portfolio, this can still make sense as part of a capital preservation and long-term participation strategy. But for someone in the capital accumulation stage, heavily concentrated exposure wrapped in the language of broad diversification can be misleading. True risk management at low net worth is less about owning tiny slices of hundreds of companies and more about making sure you don't lock your limited capital into vehicles where you have no control, limited upside relative to your needs, and significant downside tied to macro conditions. Understanding what you actually own in an index fund is essential. You are not buying a neutral wealth machine. You are buying a specific structure with specific dependencies that may or may not match your situation. Even if we assume you achieve the advertised average return, there is another quiet force constantly working against you: inflation. Nominal returns, the numbers you see on a chart, do not reflect what your money can actually buy. If your index fund returns 8% in a year, but inflation runs at 4%, your real gain in purchasing power is closer to 4% before taxes and fees. Over long periods, that difference compounds. Taxes on capital gains or dividends reduce your effective return even further, especially in taxable accounts. For someone already wealthy, a steady 3 to 4% real return after inflation and taxes can be an acceptable tool for maintaining and slightly growing purchasing power while preserving capital. For someone starting from a small base, it is not enough. Doubling a small amount of money slowly after inflation does very little to change your practical life circumstances. The harsh reality is that many people believe they are on a path to financial freedom because they are investing for the long term, but in real terms, they may be barely staying ahead of rising costs. When housing, education, and healthcare outpace official inflation numbers, your experienced inflation can be even higher than the headline rate. That means your effective real return from passive investing may be very modest. This is not a moral judgment on index funds. They remain efficient vehicles for certain goals. It's a recognition that compounding low real returns from a small base will almost always underperform what you need if your goal is meaningful, timely financial independence. By the way, if you're enjoying the video so far and want more topics like this, comment the word "more" down below. Now let's talk about a silent wealth killer most people ignore: the opportunity cost of passivity. There is also a psychological and strategic cost to embracing purely passive investing too early. When you mentally check the box, "I'm invested in index funds, so I'm doing the responsible thing," it's easy to stop asking better questions about income, skills, and opportunities. You outsource your entire financial trajectory to market averages instead of developing your own edge. This can create a subtle complacency. You may still be working hard in your job, but you're no longer actively thinking in terms of capital allocation, return on effort, or building high-value assets. In the capital accumulation phase, this mindset is expensive. Every dollar you passively deploy into a market where you have no influence is a dollar not used to increase your earning power, start a small venture, or acquire productive tools and knowledge. Over a 5 to 10-year window, the difference between someone who passively invests and someone who actively builds their human capital and business capital can be enormous. The latter often creates an engine that throws off cash flows and opportunities. The former simply hopes that market returns plus time will be enough. Passive investing can be a powerful default once you already have a strong surplus and limited time or desire to be hands-on. Before that point, the opportunity cost of going passive is often underestimated. You are sacrificing the chance to compound your abilities, reputation, and network, which can yield returns vastly greater than broad market exposure. To think clearly about where index funds fit, it helps to separate storage from creation. Index funds are excellent storage tools. They are like a reservoir, a place to hold and preserve large amounts of capital with relatively low ongoing effort, broad economic exposure, and reasonable long-term outcomes. But a reservoir does not generate water. It merely contains what has already been collected. In your financial life, the water is your surplus cash flow and accumulated savings. If that flow is small, no storage solution can magically compensate. This is where the river comes in. The activities that generate increasing amounts of surplus, higher value skills, promotions, side businesses, entrepreneurship, or specialized services. These are the engines that can transform your financial base from thousands to tens or hundreds of thousands. Without a strong river, obsessing over which reservoir, index fund, ETF allocation model is a distraction. Many people spend more time comparing expense ratios than they do thinking about how to double their income or build a scalable offer. In terms of wealth building, that is inverted. Once your river is strong, parking large chunks of capital into low-cost index funds to preserve and participate in broad economic growth can be rational. Before that, your energy is often better spent figuring out how to increase the volume of water flowing toward you, rather than fine-tuning how to store a trickle. This shift in focus, from optimizing small investments to building large surplus, changes your trajectory far more than marginal improvements in portfolio structure. If index funds are not the primary engine at low net worth, what should be? The answer is not reckless speculation or constant trading. It is deliberate, active capital accumulation. That starts with human capital, investing in skills that the market rewards, in negotiation ability, in understanding how value is created in your industry. These often produce returns that dwarf any passive investment. A salary increase, a switch to a higher leverage role, or launching a specialized service can add thousands or tens of thousands per year to your cash flow. That increased cash flow is the raw material of wealth. Next is learning to identify and execute on small, asymmetric opportunities where your effort and insight meaningfully affect the outcome. A low-capital service business, a niche online product, consulting or collaboration with others on ventures you understand. These are not guaranteed wins, but they allow you to stack experience, relationships, and practical knowledge quickly. Each cycle teaches you more about risk, demand, and execution. The key is to think in terms of return on time and return on learning in addition to return on capital. When you are early in your journey, those two often matter more. Over several years, this approach can move you from struggling to save a few hundred per month to managing a much larger surplus. At that point, moving into more traditional investment vehicles, including index funds, becomes a choice made from a position of strength rather than resignation. To translate these ideas into a practical guideline, you can adopt a simple rule. Until you reach roughly $100,000 in liquid, deployable capital, your primary role is not that of an investor, but of a capital accumulator. The exact number is less important than the principle. Below a certain level of capital, small percentage returns, even if they are positive and consistent, do not materially shift your life, especially after inflation and taxes. In that zone, concentrating your attention on raising income, reducing structural expenses, and building valuable assets tends to have a far larger impact than squeezing out an extra 1 to 2% from an index allocation. This doesn't mean you must avoid all market exposure. It means you should be honest about what actually moves the needle for you. Once you cross that approximate 100K mark, the dynamics change. At that stage, compounding begins to feel real. A 7 to 8% annual return on 6 figures produces gains that justify the administrative and psychological overhead of managing investments. Index funds can then serve their intended role, a low-maintenance way to preserve and modestly grow capital while you continue to refine your skills and opportunities. Until then, thinking of yourself as a builder rather than a passive investor keeps your focus on the levers that genuinely accelerate your path to financial freedom. Index funds aren't bad. They are just the wrong tool for this stage of your journey. You are playing a different game now. You are playing for capital. Now, the obvious question is, okay, if I'm not buying stocks, how do I actually find these big capital opportunities? That is exactly what we will be covering in the next video of this series. We're going to look at real-world examples of asymmetric bets. And there you have it, the real reason why index funds alone won't make you rich. And to make any investment process easier, we are building the Trip to Wealth Command Center, a Google Sheets system that tracks your income, spending, investing, and net worth in one place, a strategy hub. It reveals money leaks, growth opportunities, and how small changes compound. Join the early access link below. The tool will be out soon. Remember, this video is for educational purposes only and does not constitute investment advice. It is important to conduct thorough research and consult with financial professionals before making any investment decisions. The value of investments can fluctuate, and past performance is not indicative of future results. If you found value today, I highly recommend watching my next video, Mastering the 20 Rules for Successful Investing. Don't forget to like, share, and subscribe to our channel. I appreciate your support more than you know. Until next time, stay consistent, stay patient, and stay winning. See you in the next video.